Hello, hi dear students. Today we will go through on the acquisition date, which is the important step to account for business combination under Ind AS 103. So acquisition date is basically the date on which the acquirer acquires control over the acquiree. So you should remember the acquirer acquires control over the acquiree. So that's the definition for acquisition date. So we can also see a few examples when the acquirer acquires a control. That's a bit keyword. So acquiring control is a keyword here. So we will see many examples to see when the acquirer acquires a control. So probably you can go through the first example here. So in this example they have given many dates like the agreement date, appointed date, payment date, share transfer date. So these dates are bit relevant because entering into the agreement or on the appointment date or on the payment date or on the share transfer the control is not getting transferred. So here it is given that specifically the control is getting transferred by way of agreement on 1st July to 2021. So the agreement is also validated by the board of directors. So we can take that is the correct date to determine or to account for the acquisition. Okay, so here 1st July 2021 is the acquisition date, being the date of taking over the control. So this is the second example. So in this example there is a non-binding agreement being entered between two parties. So but there is no firm agreement. So non-binding agreement, it's just for reference purpose only, but having non-binding agreement will not get into any specific requirement to get the acquisition accounted. So in this case we cannot take the date on which the non-binding agreement have been entered as acquisition date. So that is not relevant here. No acquisition accounting will happen. Okay, so you can go through the next example. So in this example, on 1st April X Limited agrees to acquire the shares of B Limited in an all equity deal. So as per the binding agreement, X Limited will get the effective control on 1st April. So 1st April could be a more relevant date. However, the consideration will be paid only when the shareholders' approval is received. Okay, but the shareholders meeting is scheduled to happen on 30th April only. If the shareholder approves, approval is not received for issue of the new shares, then the consideration will be settled in cash. So in this case, the shareholders' approval may not be absolutely required because the consideration can be paid in cash in case the shareholders' approval is not received. So in this case we can effectively take 1st April as the acquisition date because on that date the control has been agreed to be transferred. Okay, so let me move on to the next example. Yeah, I just go through this example. I have given the summary of the questions. So in this case acquirer is ABC Limited and acquiree is XYZ Limited, and negotiation started on 1st Jan 2021 and agreement have been entered on 1st March 2021, but it has been given that agreement to be effective from 1st Jan 2021 itself, and even the profit entitlement also will happen from 1st Jan 2021. Okay, so but we need to go through certain specific paragraph in Ind AS 103. So para 8 of Ind AS 103 specifically states that acquisition date is the date when the control is obtained, and para 6 and 7 of Ind AS 103 states that acquisition date is the date when the parties have been exposed to or when the right to variable return have been transferred. Okay, and para 9 of the Ind AS 103 states that acquisition date when the acquirer have the legal rights. So in this case the agreement have been entered on 1st March 2021, so that should be the acquisition date, even though agreement have the clause stating that it can have retrospective effective from 1st Jan 2021, but on 1st Jan 2021 per se there is no binding agreement or there is no control have been transferred. So based on the subsequent agreement, it has been decided to give effect to 1st Jan 2021. That is only for the commercial purpose, but for accounting purpose, for the date for the agreement date was March 2021. That's the more relevant one. So here acquisition date is first March 2021. Okay, so let's move on to next example. Kindly go through this example. So in this example, the acquirer is ABC Limited and acquiree is XYZ Limited, and the party need to get a kind of approval from Competition Commission of India, that is substantive, or it's a mandatory approval that is needed. If authority rejects this proposal, then acquisition will not happen. So in this case, again we can refer to para 6, 7, 8 and 9 of Ind AS 103. So if you apply those paragraph here, we can say that only when Competition Commission of India approves this deal, then only the deal can happen. So the date on which Competition Commission approves, that will be the acquisition date, because that is when the legal rights is given to this deal. Okay, so then I will move to next topic. It's called a step acquisition. So step acquisition is nothing but the control of the acquiree transferred to acquirer over the period of time. So which means the acquirer having some initial shares of the acquiree and then buys some more shares, and then finally he buys more than 50% of shares. So in the step acquisition, the acquisition date would be the date when finally the acquirer at least get more than 50% stake of the acquiree. So that's the more relevant date. So in this example, you can see Fruit Limited acquired 15% share of Mango Limited on 1st April, and further 20% share have been obtained on 5th April, and remaining 65% is obtained on 31st March. So here 31st up to 31st March, only 35% shares have been held. So with 65% obtained on 31st March, Fruits Limited having more than 50% of stake of the Mango Limited. So here the acquisition date is 31st March. Right, okay. So in the step acquisition, you should remember that on the acquisition date, when the acquirer is having more than 50% stake in acquiree, so we need to see how much shares of acquiree being held by acquirer prior to the acquisition date. So in this case, 35% is the shares of Fruit Limited, shares of Mango Limited held by Fruits Limited. So this 35% needs to be restated at fair value as on the date of acquisition. So meaning this 35%, we have to estimate, or we have to measure the fair value on 31st March, and those shares needs to be revalued at fair value. That's a bit important when there is a case of first step acquisition. Okay, so that's important. So now we'll see one example of how the purchase consideration is determined. Okay, so in the business combination, we already seen all the purchase consideration or all the assets acquired as part of business combination needs to be accounted at fair value. Okay, and all the fair value needs to be measured as on the date of acquisition. So that's why the concept of fair value is a bit important in accounting for business combination. Similarly, the date of acquisition is also important to account for business combination, because as on the date of acquisition, all the assets and liabilities needs to be remeasured at fair value. Okay, so just read this example. Okay, so this is not the example of business combination. This is example of mere asset transfer, because the acquirer acquires some specific assets of the acquiree. So it's not business combination. And in this example, it is given that the fair value of patent is 500 crore and fair value of equipment is 1000 crore. and payment is done partly in the form of cash 1000 crore and partly by transferring land which is measured at 400 crores of fair value. Okay, so just to recollect, in case of asset purchase, the goodwill should not be measured. So in this case, actually there is a goodwill because fair value is 1,500 crores, but the fair value of construction paid is 1,500 crore, but fair value of assets taken over is only 1,400 crore. So clearly there is 100 crore of additional construction is getting cost, which is technically called as goodwill, but in this case goodwill should not be accounted for. Okay, and in the acquirer books, they are transferring land which is having current book value of only 100 crore, but it is measured at fair value of 400 crores, right? So here the book value is bit immaterial, or the acquirer needs to restate their land at fair value and recognize the profit. 400 minus 100, 300 crore, they can recognize the profit and state the land at 400 crore, which is ultimately transferred to acquirer to acquire the patents. Okay, then read through this example. I will just move to next slide. I have given summary of the questions here. So in this case, 30% of shares of XYZ Limited acquired by PQR Limited on 1st April 2021, and remaining 70% shares acquired on 1st April 2022. Okay, and it is given that PQR Limited follows equity method under Ind AS 28 to account for the existing investments. Okay, so I also given small note on Ind AS 28 and how to account for the investments. So there are some 4 important conditions to account for investments under Ind AS 28. The first one is the initial recognition of the investment should be at cost. So it will not be at fair value or some different value. So whatever the cost at which the investments have been acquired, so at that value only the investments needs to be accounted for. And any subsequent measurement needs to be done by taking into account what is the investor's profit over investee. It may be profit or loss. So on prorated basis, based on the share of investor holds on investee, so based on that prorated share value, the profit or loss needs to be accounted to the investment value. So the investment at every financial year needs to be restated based on the investee's profit or loss. Okay, and third one is we have to do impairment testing for the investment carrying value. If the carrying value exceeds the recoverable value, then impairment loss needs to be provided for. And similarly, in case of any intercompany profit or loss included on the balance sheet of the consolidated financials, so those unrealized profit or loss needs to be eliminated. Okay, and coming back to this example, so in this example, goodwill is we have to calculate the goodwill. So basically goodwill will be calculated by taking what is the value of actual consideration paid minus the fair value of assets. So here for the 70%, the paid value given is 25,000 crores, and for the 30% it is 9,000 crores. So total payment is 34,000 crore, but fair value of assets taken is only 30,000 crores. So difference between these two, 4,000 crore, is the value of goodwill. Okay, so then how the accounting entry should be made at the time of acquisition. So basically these are the entries should be made in the books of PQR being the acquirer. So all the identifiable net assets of XYZ Limited at fair value needs to be debited. That's given as 30,000 crores. So 30,000 will be debited. And goodwill 4,000 crore, we just seen the calculation, so that also will be debited. And foreign currency translation reserve 100 crore, that's already in the balance sheet of PQR, that needs to be reversed. so that's 100 crore. And the property, plant and equipment revaluation reserve, that's also in the balance sheet of PQR, that needs to be reversed to 50 crores. So the first four line item is the debit, and the next four line items are credit. So first one is cash, so cash getting paid, so 25,000 crore needs to be credited. And the investment, the carrying value of investments in the books of PQR needs to be credited. So that's in total 8,850 crore, 8,000 crore being the paid value, 700 crore being the accumulated profit till the date of acquisition, and 100 crore relating to foreign exchange reserves, and 50 crore relating to PPE revaluation reserve. Okay, and the PPE revaluation reserve also needs to be credited 50 crore because this liability is no more required post acquisition, so that needs to be reversed. Okay, then finally we have to calculate what is the gain on the 30% investment. The gain also needs to be recognized into the P&L of PQR. So gain, basically 9,000 crore is the fair value, and the cost is 8,750 crore. So 8,750 being 8,850 is the 8,000 is the initial acquisition value, and 700 is accumulated profit, and 50 is the PP valuation reserve. So only these three would be relevant. And 100 crore foreign currency translation reserve, which we already reversed, so that's not material here. So 9,000 crore minus 8,750 crore, so 250 crore is the gain that needs to be recognized. So in total, debit side 34,150 crore, and credit also 34,150 crores. Okay, now let me move on to the next example. Okay, just read through this. Okay, so let me brief you on the summary of the question. So here Sita Limited will have 6 board members of the merged entity DLC, and Beta will have 4 members. And post merger, fair value of Sita is given as 100 crore, and fair value of Beta is given as 80 crore. So Sita share is 55%, meaning 100 by 180 is 55, and Beta share is 80 by 180, which is only 45%. So in this case, who is acquirer? Sita is acquirer because Sita is having more than 50% stake, 55% in this example. Okay, so then coming to the answer, we have to compute what is goodwill, how much is the goodwill in this case. So in this case, goodwill will be 10 crore. So basically 80 crore being the fair value of Beta, minus 70 crore being fair value of Beta's assets. So 10 crore is the goodwill. And here there is no mention on the transfer of consideration. So we can assume DLC has not paid to Beta yet. So in this case, the journal entry at the time of acquisition for goodwill will be, so we have to, in the books of DLC, goodwill will be debited by 10 crores, and credit will be given to Beta account, being they are the minority stakeholders. Okay, then yeah. So in this example, I will talk about the direct cost of acquisitions. So if you recollect, in the case of a business combination, any direct cost relating to acquisition should be charged off to P&L in the books of acquirer, and these expenses cannot be capitalized. So the expenses like stamp duty, broker fee, due diligence fee, legal fee, all those things we should not be capitalized in business combination. But these things are eligible to capitalized in the case of asset acquisition. But in the business combination, we should not capitalize because all the assets and liability has been already accounted fair value. So we cannot further capitalize with all these subsequent or incidental expenses. Okay, so please read this example. So in this example also, expenses like stamp duty, etc. should not be capitalized. It should be charged off to P&L of the acquirer. But please note that we have some specific Ind AS like Ind AS 32 and Ind AS 109, through which any cost like debt or equity securities So in this Ind AS 32 and 109, there is a specific method how to measure and account those issue cost to issue debts and equity. So we'll have to follow that model. Okay, so it may not be directly charged to P&L, but let's go through Ind AS 32 and Ind AS 109 in a different session, and then see how this cost issue debts and equity should be accounted for in the books of acquirer. Okay, then okay, then let me move on to the next example. It's on the contingent consideration. Okay, so just read this example. So in this example, company A needs to pay additional 20 million if company B can succeed on few performance targets. That's what it is given here. So the fair value of such contingent consideration is also given as 15 million, and that needs to be accounted for as part of business combination. So 15 million should be accounted as contingent liability in the books of not it needs to be accounted as liability at the time of business combination in the books of acquirer. Okay, but post business combination, it is given that this liability is no more required. So when it is concluded that this liability is no more required, at the time it can be credited back to P&L. But at the time of acquisition, this 15 million needs to be accounted as liability. Done. Okay, then purchase price allocation. Okay, so I have just given few notes on how the purchase price needs to be allocated. So first one, any expected liability that need not to be accounted under the business combination. So that we'll have to make it and we'll have to understand very clearly. So only the firm assets and liability needs to be accounted at the time of business acquisition. But any expected liability which is not firm as on the date of acquisition date should not be accounted. So that's the first condition. And second, to record only those assets and liability as part of business combination. So even in the books of acquiry, if those assets and liabilities have been carried at different value or not at all recognized, that doesn't matter. But if it is taken over, we have to measure the fair value, and those assets and liabilities should be accounted in the books of acquirer. Okay, and ensure to record all assets and liability even if it was not recognized to be the acquiry. So one example can be brand name. So generally brand name will not be accounted by any company, but in the business combination, when there is acquisition, so brand names will be measured at fair value and needs to be accounted by the acquirer. Okay, then again we have Ind AS 109. In Ind AS 109, how the assets and liabilities like financial assets, financial liability, hedging instruments needs to be accounted, that has been explained. So those clauses will also applicable under Ind AS 103 business combination accounting. Okay, similarly ROI assets and liabilities will needs to be accounted as such. No need to change any recomputation of ROI assets and liability. ROI is basically the leased assets and liability, so that will have to just to be continued in the books of acquirer. And yes, all the assets and liabilities should be measured at fair value, and the minority interest, if any, that also needs to be accounted at fair value. Minority interest is also called as a non-controllable interest, NCI. Then contingent liability also, we need to account or we need to recognize those liability on a specific circumstances. So we have Ind AS 37 that gives how and when contingent liability needs to be accounted or disclosed, but there is one small element which the way in which the contingent liability needs to be accounted for is a bit different under Ind AS 103. So basically, if we have any possible obligation, then both in Ind AS 37 as well as Ind AS 103 will not be recognized. It's only possible obligation. But if you have present obligation, but probable, but not probable to result in any economic outflow, then under Ind AS 37 this need not have to be recognized. Under Ind AS 103, in case if the probable economic outflow can be measured, that needs to be accounted as liability. So that's the only difference. So even the third point to add present obligation, but it's unable to predict the future economic outflow, then in both the cases no need to provide, no need to recognize. Okay, then just read through this example. So in this case, acquirer is company A, acquiree is company B, and contingent liability in the books of company B is given as 10 million INR, and fair value of contingent liability estimated by company A is 2 million INR. Okay, so answer is, even though the contingent liability of 10 million INR not provided by company B, on acquisition date company A needs to estimate the fair value of the contingent liability and should be recognized upon acquisition. So that's the Ind AS 103 condition. So in this case 2 million INR is the fair value, so this needs to be accounted for on the acquisition date. Okay, so then let's go through the next example. So in this example, company A acquires company B and existing contingent liability given as 250, and sellers of B provides indemnification to company A for 150 crore. Okay, and the fair value of contingent liability is given as 250. So in this case 250 should be accounted as the firm liability and 150 should be recognized as the indemnification asset. So both should be brought into balance sheet. So 250 is a liability and 150 is asset. Okay, so then read through this next example. So here company ABC acquires company PQR. Existing contingent liability given as 2 crore and fair value estimated by ABC is 70 lakhs. And sellers of PQR provide indemnification to company ABC for 1 crore. So in this case, since the fair value is only 70 lakhs needs to be accounted as liability, and also 70 lakhs needs to be accounted as indemnification asset. So even though the indemnification asset is 1 crore, but we estimate that will be used only up to 70 lakhs. So only 70 lakhs needs to be recognized as indemnification asset. So since both assets and liabilities are same, no goodwill impact will be there in this case. Okay, then please read this example. So here company ABC acquires PQR and existing contingent liability is nil, but there are 10 cases against ABC. However, the outcome is difficult to estimate. XYZ Limited provides indemnity to ABC up to 10 crore. Okay, since the fair value estimated by ABC is nil, no liability to be recognized. Correspondingly, no indemnification asset also needs to be recognized. Okay, then next chapter we will move on to intangible assets. So as per the guidance note, it is judgmental to recognize intangible assets. So this is a bit important. So when to recognize the intangible asset, it's a bit of judgmental. So we'll have to decide on case-to-case basis. Okay, and maybe I have tried to give a few examples in this material, which will help you to determine when to recognize the intangible assets. So basically, in case of any significant R&D cost, if it is there, then that could be a kind of indicator to see any possible technology related intangible would be available. So if so, that can be measured and accounted. Similarly, if there are any significant marketing cost with acquiring, so that can also be one indicator to determine if any intangible assets with respect to marketing or distribution network are there. Okay, so maybe you can go through this example. So here company A, which is a FMCG company, fast moving consumer goods company, acquires company E, which is the e-commerce company, and company has intangible asset in terms of customer list over 10 million. So in this case, yes, that is intangible because they have the big list of customer, which can be separately measured, and we have to apply some value to determine the fair value of those list of customers, and that needs to be separately accounted as intangible on the acquisition date. Okay, so this example also please go through. So here ABC acquires XYZ, and both are pharma companies, and XYZ has spent significant amount of R&D and developed two drugs, and one drug is already approved by authorities and second drug likely to be approved in 2 years. So in this case also, all the significant expense spent on R&D, there is a kind of intangible available, so this needs to be measured and needs to be accounted for on the acquisition date. Okay, and maybe you can also refer to Ind AS 38, which states that the value of intangible should be measurable and have potential to generate a future economic benefit. So we'll have to see what is the future economic benefit with respect to this intangible. So that will be the fair value of these intangibles that needs to be measured and can be accounted for. Okay, so please read this example. Okay, so here note on reacquired rights. So as per Ind AS 103, any intangible assets relating to reacquired assets needs to be recognized separately on acquisition date. So this is important. So any intangible assets relating to reacquired rights needs to be recognized separately on acquisition date. So in this case, Vadapav has given franchisee rights to Efficient Limited, and Vadapav now decided to acquire Efficient Limited. Okay, so here Vadapav needs to measure the fair value of the intangible assets of its own franchisee rights given to Efficient Limited, and this needs to be accounted separately as part of acquisition as intangible assets. Done. Okay, so just go through this next example. Here ABC acquires PQR for 1 crore, and ABC also provides license to PQR to operate in Europe market. The value of license was 2.5 lakhs for a period of 10 years. Already 4 years expired and remaining 6 years are there. So given the market value of license on the acquisition date as 4.5 lakhs for the remaining 6 years. Okay, so in this case the answer is the intangible asset of 4.5 lakhs being the fair value of license to be separately recognized, and 1.8 lakhs being paid to acquire back the 6 years license that needs to be expensed off in the books of ABC, and the net consideration will be 1 crore minus 1.8 lakhs being paid to acquire back the license. So the net consideration in this example is only 98.2 lakhs. Done. Okay, so with this let me conclude today's session. We'll again come up with another session very shortly. Thank you.